Yesterday, SpaceX reported impressive quarterly results with earnings per share coming in at 9 cents per share compared to expectations of 29 cents per share loss, totally blowing it out of the water in their first report as a publicly traded company. But during that call, SpaceX CFO said something that really caught my attention. He said SpaceX is seeing a payback period of less than 1 year on its AI capex. That's an incredible claim. But here's the issue. SpaceX AI capex grew 8 times faster than its AI revenue in the latest quarter. And just for reference, Meta saw capex grow 3 times faster than its revenue, while Google saw its capex grow 4 times greater than its revenue. As it stands, SpaceX is roughly double that than its peers. That begs the question, is this the smartest capital allocation strategy in the industry right now? Or is SpaceX taking on more execution risk than investors appreciate, or more than they even realize? That's the question of this video. Is SpaceX becoming the next AI hyperscaler or the next CoreWeave? And here's the line that sets up everything that follows for the rest of this video. Google has Search, Microsoft has Office, Amazon has AWS, and SpaceX, it appears, now has Starlink. Every hyperscaler funds its AI bet with the cash printing core business. And this quarter, SpaceX officially joined the club. The question then is whether that bet that it's funding looks more like Google's AI build-out or CoreWeave's build-out. To answer that question, we need to understand that SpaceX isn't really one business right now. Instead, it's 3 different businesses wrapped in one. There's the cash flow engine, a bet, and an option. Let's start first with the engine. Starlink generated $4.3 billion in revenue in their latest quarter, up 66% year over year. But almost as important as how much money you make is how much you keep. And SpaceX improved on that metrics too, with operating margins increasing from 35.6% a year ago to 38.6% in the latest quarter. That's margin expansion at scale. And that's not a business generating more efficiency by accident. That's a business scaling with real pricing power and customers who are willing to pay up. And we see that in the subscriber numbers. That doubled year over year to 12 million users. Now that growth came at a cost, with average revenue per user dropping 22% to $66 per user. And normally that would be cause for concern. But I believe this is a classic land grab trade-off. They're pricing to grow the customer base today, and overall, consumer revenue was still up 44% to $2.5 billion. And more interesting than the consumer segment is the enterprise and government revenue segment. That was up 108% year over year to $1.8 billion. On the enterprise side, they signed major deals with American Airlines, and they started services with Southwest, Virgin Atlantic, and other airline carriers. On the government side, Starshield linked 2 contracts with Space Force worth more than $6 billion over the next years. Now, on top of those immediate initiatives and those immediate wins, a bigger opportunity opened. Not necessarily one they're going to pursue, but it's there if they want to. The FCC approved SpaceX EchoStar license transfer, handing them 65 megahertz of spectrum in the US, plus global mobile satellite. This opens the door for SpaceX to compete directly with everyone's favorites, AT&T, Verizon, and T-Mobile, offering direct satellite to cell phone service, 5G service, with no modifications required. That's a game changer. This, in a nutshell, is SpaceX Google Search. Well, this is their Google Search, right? This is the business funding everything else that we're going to talk about. Now, the part of the business that actually everyone wants to hear about, the AI part. That brought in roughly $2.6 billion in revenue, up 250% year over year. And on the surface, that sounds like an incredible number, and it really is on its own, right? But I want to walk you through it because this is where the bull and bear case both meet. This is where SpaceX can become the next hyperscaler giant or the next CoreWeave. So let's start with the bear case, the CoreWeave case. Most of that AI revenue, $2.2 billion of it, comes from selling excess compute to just 2 customers, Google and Anthropic. The Anthropic deal alone is worth $1.25 billion a month over the next 3 years. And Google's deal is worth $920 million a month, running from October 2026 to June of 2029. And those sound like phenomenal deals at a high level. But here's the catch. Both of those deals can be canceled with just 90 days notice at any time starting in 2027. This means that SpaceX's fastest growing segment consists of 2 customers one of which doesn't make any money, and both of which can walk away with just a 90 days notice. Meanwhile, capex for this AI segment jumped 2,000% from $749 million a year ago to $15.8 billion in the latest quarter. That's the 8-to-1 capex to revenue ratio I mentioned earlier in the video. That's the highest of any player in this space. And here's the risk laid out plainly, so there's no confusion. The plan for SpaceX is to monetize its compute by offering NeoCloud services, essentially reselling the compute the same way CoreWeave does. But it's important to note that Meta is also moving into this space. And I don't just bring that up just to talk about Meta. It's because that means this space risks becoming too crowded and the service risks becoming commoditized. If that service becomes commoditized, margins get compressed. And what is currently capex turns into cash burn very quickly. And at the end of the day, SpaceX could end up just being a glorified AWS reseller without the AWS pricing power. Now, that all sounds really bad, and it could turn out to be that bad. But there's also a bull case underlying all this, right? The hyperscaler case. Let's jump back to the claim made by the CFO. CFO Brett Johnson told investors during the earnings call that demand for its AI chips is so high that SpaceX is seeing a payback period of less than 1 year. If that's true, an 8-to-1 capex to revenue ratio isn't reckless. It's simply aggressive, very aggressive, but it's a measured bet, right? And to add to that bull case, something that truly separates SpaceX from all the other cloud providers is a moonshot possibility of data centers in space. According to FCC filings, SpaceX plans to launch millions of satellites into space. Each one would be its own compute node, and they would all communicate with each other over laser links and use solar power to power all their operations. Now, granted, this is a moonshot and it's a bit of a fantasy, but this is exactly what separates SpaceX and puts it in a league of its own. No one else on Earth can replicate this. No company, and likely no country, except maybe China, right? So here's the tension we have to contend with. In the near term, the AI risk looks a lot like CoreWeave. We have a concentrated bet with only 2 customers, Google and Anthropic. Again, one of them doesn't even make money. And also, these revenue segments aren't easily cancelable with just a short 90 days notice, and they take a lot of heavy capex up front. The long-term AI vision is the hyperscaler upside. It's the structural moat that doesn't exist yet anywhere else in the industry or anywhere else on this planet for that matter. Unfortunately, we can't yet decide which way the cards will fall. That's not a cop-out, that's simply a statement of fact. We don't know just yet. Anyways, turning over to the last revenue segment, the smallest revenue segment, rockets. The space division reported revenue of $962 million, up 29% year over year. Customer launches increased slightly from 9 launches a year ago to 10 in the latest quarter. The real headline for the space division was Starship V3. Flight 12 that happened on May was the first suborbital V3 mission with a clean liftoff and a precision landing. Flight 13 in July went even further, deploying 20 production satellites, relighting a Raptor engine in space and landing, making the softest splashdown yet. All very impressive feats of engineering, no doubt. But think of this segment more as a call option. It could pay off huge if Starship reaches full reusability, but it's not why you would be buying the stock this quarter. Now, despite the clear growth we've already seen and the opportunities that exist for growth going forward, there's one major headwind for the stock besides the execution risk that we've already discussed of it becoming the next CoreWeave, right? On August 6th, roughly 911 million shares become unlocked and tradable, more than double the current flow of roughly 638 million shares. And on August 20th, we get another 319 million shares unlocked. So regardless of how you feel the fundamentals and regardless of how the next quarter plays out, there's real supply pressure hitting the stock over the next few weeks and over through the end of the year actually, not just in August. So pulling it all together, we have an engine, a bet, and an option. Starlink is funding all of this, and it's getting more profitable over time as it gets more customers, as it scales. AI is the bet. It's the only piece of this that's actually binary. It's either go big or go home, right? Become a hyperscaler or become CoreWeave. And right now, unfortunately, at least to me, the financials lean more towards CoreWeave than the next big hyperscaler, as we have seen that they have a concentrated customer base that can easily cancel their revenue agreements, and they have massive heavy capex today. The satellite compute vision is what could flip all of this at a later date. Unfortunately, it's not proven yet. And space overall is a call option. Real progress can be made there, but it's optional upside, at least in my eyes. And that's pretty ironic given that the name is called, again, SpaceX. Anyways, that's exactly why I'm not buying today at $108 a share. I'm eyeing a low around $80, so we still got some more downside. And I'll likely start dollar cost averaging around $95 a share. With 2 large unlocks hitting over the next 2 weeks, I think the technical pressure alone keeps pushing the shares even lower, irrespective of what happens with the fundamentals. And eventually that story will get resolved and we'll see how that plays out. But at least for today, expect more downward pressure. Anyways, that's it for today's episode. If you found this information informative or even mildly entertaining, please smash that like button and consider subscribing. I drop videos like this every single week. And later this week, I'll be dropping a video covering AMD and SK Hynix and how that relates to what Elon Musk said during his call when he was talking about NVIDIA during the earnings call. Anyways, until next time, protect that lunch money.